or at least on this planet, probably knows. I have this map up. It's not a market map, as you can tell. It is from a website here in the United States. By the way, everyone who is on this webinar, if you have any questions, comments, or anything else you'd like to add, or jokes, as I always ask for, please type it into the chat. It is up and it is being monitored, and I will be glad to stop and consider what anyone has said. The reason this map is up, and the reason we're going to talk about it initially rather than talking about the markets, is because I've been following this, of course, rather closely. It's part of my job. It's also part of my own interest. But this is a map from a website. Well, let me backtrack a little bit. I'm not sure how many Americans are online here. And even so, I'm not sure how much people know about these things. Everyone has a general sense, I suppose, at least in this country, that the president is not elected and the vice president are not elected directly by the popular vote. They're elected by something called the Electoral College. What that comprises is each state has a certain number of votes. The number is determined by, if I remember correctly, the number of congressmen, representatives, and senators. And then they vote for the president. Each state matters to a greater or lesser degree depending on its population. So, might just be the number of representatives. You know, I'm not sure. Should check that. Sorry. Anyway, let's see. Is there any state less than 2? We can tell this right away. No, there is not. So it is, in fact, the representatives and the senators. So if you look here at Maine, you can see that Maine itself has 2, but Maine is divided into two different districts, and each one there are 2 districts here. Each one has 1 representative. If you look at Vermont, that means that Vermont has 2 senators and 1 representative, therefore it has 3, and on and on and on. The number to win is 270. This is a website called Real Clear Politics. If you're interested in American politics or in any other topics, including economics, markets, they're a very good series of websites. What they do, and they're relatively new, they were founded about 15 years ago, I think. What they do is they take articles from both sides of any particular question, or as many sides as there are on a particular question, and they post them. It's an aggregator site. And so you get a very good idea of the breadth and also the arguments on from more than one point of view. It's an extremely valuable site. It's the only really successful one that I'm aware of out there. So what you're seeing, of course, is what everything gets reported in the media worldwide is that the Democratic candidate, Hillary Clinton, is leading in the polls. And this seems to be true, at least as far as the polls go. Polls are, as all of you in Great Britain know, and on the continent, are imperfect. And they can certainly get things wrong. They can reflect, in addition to the wishes of the people polled, the assumptions of the electorate, and the assumptions of the pollsters. And we certainly saw that in Brexit. It was from a market point of view, a very fun night, meaning that I enjoyed the volatility was fun. But the polls are wrong. So that's the reason I bring that up now, because we have a discrepancy that I want to point out in the webinar, so that I think everyone is aware that this, as I've said constantly over the past several months, that this election, I think, is far closer than is being credited for. Now, we will talk in a few minutes about what the markets have made out of this. And markets are essentially agnostic. Not entirely, of course, but what they want to get right more than anything else is the winner. The fallout from the victor's potential policies, or lack of potential policies, whatever you want to call it, is something that the markets will deal with later. What they want to deal with right now is getting the election right. We're going to see that there has been an up and down movement in the markets, some more than others. Equities probably most pronounced with yesterday's 370-point rise in the Dow, based on a political factor, purely on a political factor. And it's not even a well-represented political factor, but it is the way the markets interpret it. But I'll talk about that in a second. So what we're seeing right now, and this is to remind everyone that volatility lurks. Polls, no matter how scientific they are based on assumptions. How many of each group are going to show up at the election? What's the turnout going to be? And things like that. Those are assumptions. And much like trading programs, which work for a while and then no longer work, it's because the underlying assumptions no longer apply to current market conditions. Just as a brief example, if you assume that a particular group of people, however you categorize them, are going to perform, meaning show up at the polls and vote in the same percentages as they did at prior elections, whatever prior election you choose, that assumption is accurate as long as the conditions that produce the prior attendance and voting at the election remain true. As we all know, things change, and they change relatively rapidly, and this being a very unusual election in the United States. So, looking at this chart, this tells you, or this graph, what this does is it takes an average of polls, I think they go back a month. There's been a lot of polls in the United States for each state. It simply averages them. It doesn't favor one over the other. It just takes a bunch of polls and averages them. And the logic being that assumptions will cancel out and we'll end up with the best idea. It's been a pretty accurate way of doing things. Plus, their maps are great because you can do your own map. It's a lot of fun. You can spend hours on this particular website playing with their election tools. But what this state does, so that every state here simply is categorized by who's winning, who's leading in the polls, regardless of how small it is or how large it is, and whether the polls are within the averages within the margin of error. Not doing any of that. So this is interesting because it's at quite remarkable odds with, and this is the way the election is decided, through the Electoral College from each state. It's at quite remarkable odds with the national polling, which just says who will vote more for one candidate or the other. Those polls are showing Mrs. Clinton with about a 3-point lead over Donald Trump. This map is showing it essentially tied. Not essentially, showing it tied. Some of these states here, here are very thin margins, less than 1%, which, as far as polling goes, is not very reliable. Nonetheless, if the votes were taken out, if the voting played out exactly as the polls in individual states, it's much easier to poll an individual state because it's a smaller population. It's often more homogeneous. You have to make fewer assumptions. It's a very big country. So localized polling tends to be more accurate than national polling for obvious reasons. Great breadth, width of both geography and culture in the United States, without going into the history. So, as I said, local polling tends to be more accurate. So were the election to fall out exactly as the poll averages had, Mrs. Clinton would win, and she'd win by the slimmest of possible margins. Now, this is not, of course, the popular vote. This is, as I said, the Electoral College. The reason I bring this up is because there is a great deal more chance, I think, for volatility in this election, not only even if it comes out as the national polls predict, but as with the Brexit vote, the individual localities report at different times. Each one of these states has its own polling apparatus, has its own hours, has its own methods of polling, meaning voting. And so they will report, of course, on a rolling basis from the 3-hour time distance from the East Coast to the West Coast. And markets will, as they did during the Brexit vote, and UK is a much smaller country, react to the individual states, some being more significant than others. For instance, the state here, Pennsylvania, is now polled, the polls up point to a Clinton victory there. Were that to be different, were the results starting to come in, and they come in over time from the state, so you'll get 5%, 10%, a long drawn-out process. If that state trends towards the Republicans, then you will see a huge shift in the markets as that is reported, because the assumption will be that if that state is going to vote for the Republican, then many, many other states of similar type demographics are going to also. Conversely, if you see Florida start to come in and be reported as a Democratic state, meaning it votes for Clinton, then you will also see less of a shock, but a movement nonetheless. The reason you see less of a shock is because markets have largely priced in a Clinton victory. I'm not quite sure why. This map, I remember distinctly listening to the returns as they came in from England, from the UK, on the evening of the 23rd. And there was one of these indicative areas, and I'm not sure exactly where it is, called Sunderland. And if I remember, Sunderland had been polling for the Remain within the European Union side, but weekly. It was kind of a swing area. And as the polls started to come in, it turned quite dramatically, if I remember, to the Brexit side. And so as soon as those results started to come in, the pound took an absolute nosedive. I remember tweeting it out, 3 figures in a minute, an astonishing move for the currency markets. Because as it turned out to be, the polls are wrong. The indicative value of that particular area, Sunderland, turned out to be very accurate. And as we know, the Brexit vote actually won quite easily. I mean, not by a huge amount, but once the voting started to come in, there were essentially no surprises. So I have a question, of course, as to why the markets have priced in so heavily a Clinton victory. Nonetheless, they have. And so we'll look at that in a second. Okay, so just to keep everyone aware, and I'm going to be here in our trading room well on into the evening. We'll see how the election goes. I am planning to stay until there is a victor, although I may go to the gym in the meantime. However, if we are 4 or 5 o'clock in the morning and there is still no victor, I may actually pack up and drive home to New York. But at any rate, I will be posting and commenting throughout the evening. We have a full array of news outlets here in the office. I will also be commenting for the media, of course. So we shall see. As always, it should be interesting. Okay, so let's take a look now. So I just want everyone to be aware that the election seems to be closer than indicated by the national polling. But we shall see, okay? Now, let us look so far at what the markets have made of this. And first, we're going to look at the currency markets. And I'll start with the DXY and see if we can get any pattern here from the DXY. And I think you will see a pattern, okay? So this is the, the Chicago Merc DXY, not the trade-weighted DXY. The problem with the trade-weighted DXY is it's from the Fed. It's not a traded instrument. They measure it. I think you can trade options on it. But it's retrograde. It's a quarter behind, so it doesn't really do you much good when you're going to look at current market movement. So anyway, this is the trade-weighted, this is the DXY. And there are all the things on here that you expect, okay? Brexit vote right here, huge spike in the DXY, collapse in the euro, the sterling, and some of the other currencies. As far as the election goes, now remember, the Americans, we tend to, like the Europeans, we go on vacation in August. There's been lots and lots of campaigning going on, it seems endlessly, but the electorate don't really start tuning in until September, till everyone comes back, till after Labor Day. Through this period here, through the conventions in the summer, through this period here, first the Republicans got a boost, Mr. Trump from their convention, then the Democrats and their convention. Clinton got a boost, but people weren't quite paying attention. The polls were variable. As people started to come back, there has been a decided movement in the polls to Clinton. And that has proven largely in the market's interpretation to be dollar positive. And you'll see this in the specific currency pairs, the euro and the yen as well. But for the weighted average, the prospects of a Clinton victory benefited the dollar. And the reasons are quite obvious. Mr. Clinton is a Democrat. President Obama is a Democrat. The assumption of the market, and also what Clinton has said, is that with some exceptions, and none of them I take seriously, certainly her avowal of moving away from trade agreements, I believe is nothing more than campaign rhetoric. She's certainly in the past supported all of the agreements that the Republicans and Donald Trump have criticized. At any rate, Clinton, there can be no question, represents continuity of policies and continuity of politics. Mr. Trump, on the other hand, being not until very recently a politician, having far less familiarity and far less coverage in the election of actual policies, possessing a far shorter list of potential appointees to the government, and having been critical of many of the policies and the economic status of the United States over the past 8 years, as one would expect from an opponent, is far more problematical about what he will do, what his views would be. So just based on that alone, the markets have made a very sensible choice. If they get Clinton, they know what they're getting. They get Trump, they don't know what they're getting. And I'm not sure anybody does, but certainly the markets don't. So the movements that we've seen here, this has been the attention to the markets throughout most of this period. Clinton was leading in the polls. This was and is that dramatic announcement. Remember, during this period here, well, never mind about that. This red arrow here, the decline in the dollar, rather pronounced decline in the dollar, almost two figures, was when the FBI announced that they had found some more emails. There's this vast email scandal going on here in the United States having to do with Mrs. Clinton and her emails, and the fact that as Secretary of State, she did not use her government email address. I assume most Americans know about this. I'm not sure if the Europeans do, so I'll mention it briefly. The FBI investigated. They said they would not recommend criminal charges. In itself, an unusual event, because they actually said that they didn't think that she could be successfully prosecuted. That is not actually the FBI's role. The FBI simply makes a recommendation, and then the Justice Department, that would have been Secretary Lynch, would have made the final determination regardless of what the FBI recommended or not. That's not what happened here. At any rate, that initial finding from the FBI was that although they did not recommend or think that Mrs. Clinton could be successfully prosecuted, that she had been extremely careless and had made a lot of very, very trenchant criticisms, and on subsequent admissions actually said that there's no doubt, I think they said 99% certain at some point, that that email system that she kept in her home in Chappaqua had been hacked by various foreign entities and most of the information stolen. At any rate, Ms. Clinton was not charged. And that led in many ways, to this rising market perception Mrs. Clinton would win. At the peak of this right here, when it turns down, the FBI said that they had reopened their investigation. They later, as in last Friday, said that they had found nothing new. But you can see certainly that the rebound is far, far weaker than the fall. There is apparently, in market judgment, a more than lingering problem from this second investigation into Clinton's email procedures. But as you can see, and then Friday, the FBI said, no, we're not going to do anything again, so you have another recovery in the DXY. This pattern holds to a greater or lesser degree. It actually holds in a lesser degree to the currencies across all markets. I hesitate to say that this is a sign of approval, but to some degree it probably is. And the basic reason is Clinton's associations with the markets are far stronger, and she is an utterly establishment figure, both in her campaign, in her comments, and in her political associations. So markets in general feel they know what they are getting with a presidency of Hillary Clinton. And nobody, and certainly not the markets, know what they're getting with a presidency of Donald Trump. And that's part of this issue. Okay, so that's the dollar to DXY response. Now, there's one other thing I want to show you. I forgot to bring it up here. Remember I showed you that the earlier graphic, this one here, let's do it this way. Okay, this one here, which gives you the Electoral College potential victory according to the Real Clear Markets polling averages at the moment. You can see it's basically a toss-up. You need 270 electoral votes to win. If the voting took place exactly as the statewide voting took place exactly as the polls predict, Clinton would win by 2 because she needs 270. The switch of any one state would change the result of the election. And Vermont, because they have less than 4. It is possible, in fact, to have a tie if Vermont, now this is not likely, if Vermont turned in Republican, then it would be 269 to 269. For those of you who have not studied American constitutional procedures, if that result holds up, I'm sure if the individual state elections were close, there would be recounts. If that held up, then the election would go to the U.S. House of Representatives, where the Republicans currently hold a majority. A majority, I guess, is expected to be maintained through the election. That would theoretically, at least, give the election to Donald Trump. So that's where it's possible. It's happened once before, if I remember. No, twice. One of them was the first election that Andrew Jackson participated in, 1824, I think. And then there's another one that I don't offhand remember. Okay, so that is if the voting took place exactly as the polls indicate today. This is this is a more mathematically precise map. This takes into account the polling averages and the margin of error. The red and pink states are states that whose lead of which candidate is outside the margin of error, therefore to some degree is considered a much more likely event that the state votes for the particular candidate. The gray states are states where the election is too close for the statistical pollsters to consider. I pretty much know offhand who's running in these states. In Florida here, Trump is leading by a small amount. In Ohio here, Trump is leading by a small amount. Michigan here, Clinton is leading by a small amount. Pennsylvania here, Clinton is leading. New Hampshire, I believe Clinton is leading by a very small amount. Maine, I believe, who's leading in Maine? I believe Trump is leading in Maine. Virginia, Clinton. North Carolina, Trump. Georgia, Trump. Colorado, Clinton. Nevada, Trump. New Mexico, Clinton. Arizona, Trump. And Iowa here, Trump. Now, these states, according to statistical procedures, could swing either way. And in some of them, the margins are so close. In the election of 2000, Florida turned the election. That election actually wasn't decided until in December 12th. So that's more than a month. The dispute was over who won the state of Florida, and it turned on a few thousand votes. And had those few thousand votes gone to Al Gore, then Al Gore would have won the 2000 election. So that's how closely divided the American electorate is currently. Okay. Now, let's take a look at some of the other markets. Go through the currencies first. We'll look at the DXY. Let's look at the euro. Let's take a long view first. Give you a sense of where we are. This is the euro over 3 years. It's fairly clear when you look at this chart what's been going on. Even the effect of the Brexit vote, which is right here, is minimal comparing to the movement we've seen since 2014. What is this largely due to? Well, in my mind, it's largely due to the end of the Fed's quantitative easing program and the advent of their rate hike. Now, the rate hike wasn't until here, December of 2015. We're probably going to get another one here. But the Fed's been talking about it with increasing frequency and increasing force for all this period here. And plus, QE ended in the fall of 2013. So you can see from this that the relative movement in the euro, at least, relating to political developments, one which took place as a shock, the vote to leave the European Union, and any relationship here back in the United States is minimal. And as far as the actual Fibonacci's go, the euro hasn't even regained the 38.2% line. So the euro remains under the spell of the divergent central bank policies. The Fed, to whatever degree, hiking rates, and the Europeans maintaining their monetary accommodation. And that's the greatest behind this chart. So let's drill down a little bit, get a little closer. This is the 2-year. You can see already the amplitude of the moves are changing. This goes back to 2014. This is the Brexit vote. Okay, now let's take a look at year to date. And this gives us a greater sense of what's going on. This is the Brexit vote in the euro. Makes sense? Although it wasn't nearly as dramatic as the sterling vote, in my mind, the Europeans have almost as much to lose from a bungled set of negotiations with the British as the British do. And they have as much to gain. I'm not sure they'll see it that way. The Europeans' problems, of course, are politics. The Italians have a vote on Matteo Renzi, he is the prime minister, proposal to change the constitution somewhat to make it easier to govern Italy with less resort to small sort of fringe parties as political balancers. If that vote fails, Mr. Renzi said he will resign. If he resigns, then it's quite possible that Pippo Grillo, who used to be a comedian, is now heading a party called, I believe, 5 Star, is the leading poller in Italy. And there are parallels here. And this is why I warn people to be a little wary of what they're reading and talking and hearing from the media. Brexit, remember, I repeat it again and again, was destined to fail, not only through the polling, but through the advice of practically every commentator, pontificator, and otherwise talking head throughout Europe. Did not. Mr. Trump has never been in politics before, really. Be wary of views. And the same, I would say, would be true for the 5 Star movement in Grillo in Italy, in a vote which takes place in around a month from now. Because the 5 Star party has a platform to leave the euro. That the euro has been a drag and a constraint and provided nothing but damage for the Italian economy. Without arguing the merits of that idea, it is one which seems to be resonant in Italy. The Italian economy has essentially not grown for 15 years. It's essentially the same period as the euro. So anyway, there are more currents here than are initially apparent, certainly if you limit your gaze to the United States. There is some degree of, we'll call it quite comity or maybe coincidence of uniformity across a number of nations in the industrialized world because they're seeing similar results and the populace and the electorate is having similar reaction. Okay, but at this chart here, so in the euro, remember, this is the reverse. This the euro goes down. This is the reverse of the DXY, of course. In this period here, the dollar goes up. Clinton ascendancy in the polls. Here, euro goes up, dollar goes back down. Trump revival in the polls. And this brief and small movement here, again, Clinton revival in the polls. So again, we're seeing the same thing we saw here in DXY, that the markets are pricing in, if they have a preference, it is for a Clinton victory. In my mind, this is not a political judgment very much. It is particularly a market and a continuity judgment. Okay. This is sterling. We all know what these charts portend. Sterling, as with the euro, has been in a downward channel since the summer of 2014, and for exactly the same reason. Changing interest rate outlook and balance between the BOE, the ECB, and the Fed. Notwithstanding, the Brexit vote, which of course you see here, was a tremendous shock to the system in Britain. Now, unlike the recovery we've seen and then the fall again in the euro, the pound has been relatively firm in its direction. There was some consolidation here, but again, we've seen a fall off. This relates largely, well, it relates twofold. My guess is that it relates largely to the pending negotiations with the Europeans over leaving the European Union. However, the time frame also fits the change in outlooks for the U.S. election, as far as the overall trend in the euro is, I mean, in the sterling is still down. But the impact of the U.S. election here and then here, dollar up, dollar down, we should get a dollar up again, are reflected somewhat, at least, in the comparison. Here, let's look again. This is the euro and the sterling. Okay, hang on. Okay. And here we have the same thing. This is the euro and the sterling. We can see that they're very closely allied. The reason I put up the euro, and I'll tell you in a second, Brexit vote, Clinton ascendancy, Trump resurgence, Clinton slight recovery. So again, in the background of all these charts are the essential fact, more important than anything else, that Clinton and the Democrats represent continuity for the simple reason they're currently in office. Okay, now let's look briefly at some, let me show you the FTSE. We have a kind of similar, not surprisingly, everybody's got the same stuff going on. Like the Dow and the American equities, the FTSE has been rising since the end of the Chinese fall, when China devalued its currency. By the way, nobody's paying attention to China. They've been devaluing their currency steadily, and I believe they did again today. They also fired their finance minister. So, forget not the mainland. It matters. Okay. So here we have, the same movement. In the FTSE. Up during the period of Clinton ascendancy, down a bit during the Trump resurgence, and then back again with Clinton. Again, the same exact reflection for the same reasons that you're seeing in most of the equity markets relating to the US election. Okay, so now we looked at currencies, and we looked briefly at equities. But before we continue with equity, I want to take a look at two other things. The first is the 10-year generic treasury note, the yield on the treasury, and see if we can find any particular type of pattern here. Okay, so this is the US 10-year. Ever since the Fed has been getting serious about, at least getting serious about talking about raising rates, what do we get? Well, we get stronger rates. And this has held throughout the varieties or the vagaries of the electoral process here in the United States. This is actually well coordinated, but you can see how much smaller it is for against the overall trend. This is actually the movement of rates back down again as Clinton was being reinvestigated by the FBI, and then a bit of a relief here as far as the recovery goes. So there's nothing, again, unusual. We're looking again, but with different amplitudes here. The credit markets are responding much less forcefully to movements in polling and market perception for a very simple reason. Even if Donald Trump's elected, he's not going to be replacing Janet Yellen immediately, although he has said that he would. He didn't say immediately. So the prospects for a rate hike in December remain very high. They diminish somewhat with Trump, but on this topic, if Trump is victorious, but on this topic, I don't really think anyone has a clue how Mr. Trump would deal or would comment on this particular situation as far as the electorate goes. He has said that he would like to replace Janet Yellen, but how and where and why and everything else to go with it is unknown. So the basic effect of a Donald Trump victory would simply be an increase in volatility. You would see the VIX shoot up. And you would see less holding positions overnight. You would see all of the things that go with heightened volatility. Okay, so that is the US 10-year. Let's take a look at the 2-year. Okay, the 2-year. Similar chart, similar movement as you'd expect, similar logic. Nothing you're seeing here. The main point that I want to make with the credit markets are they're not really changing their judgments about Fed policy based on the election. It would seem to me that even if Janet Yellen were replaced, that the Fed policy would still have to be tightening at some unsubstantiated period, because at this current marketplace, there's nothing else you can do. Okay, so that is the 2-year. Let's take a look at gold. I'm saving the best for last, okay? Next is gold. Okay, gold. Now, gold is an interesting case because, gold is primarily a responder to inflation and a responder to volatility, to concern, to worry. And we can see that here, of course, in June, this tremendous spike in June. By the way, just so you know, as an old follower of chart patterns, look what happened here. You had this tremendous Oops, I think we may have lost the chart. Let me put it up again. We did. I think I hit a button. Okay. The old line, gaps will be filled, also applies, meaning that as a market gaps through a particular level, there are no orders left there. There were very few deals done, so that there's no weight on the order board to absorb either selling or buying as a market goes through that level again. So when you get a day with a particularly wild move like this, and much of this time there was very little trading because it was just going bananas. That's, of course, the Brexit vote. You almost always, at some point in the future, get the currency or the commodity back to its original level. And you can see that's exactly what happened here. The gold went down almost exactly to the level that, a little bit further, but not much, to the level that gold started at on the day of the Brexit vote, June 23rd. So it came down and then it's climbed back up again. So what do we have here? Okay, so we have the Brexit vote, and this is the early October vote, right? Because September, October. And that's a combination, of course, of technical levels and the rise of, again, the same reaction, the rise of Hillary Clinton in the US polling. And the logic being the same as all of them: more continuity, less volatility, less chance of things being left in the open, less chance of weeks and weeks without decisions or policymakers, all the things that go with a relative neophyte for politics and a lack of campaign, both structure and people. So gold has the same exact notion. As we get, now this of course is not entirely relating to the fortunes of the US election, but there's a portion of it. We get the gold returning as the FBI reopens its investigation and then falls off again here. Okay, so that is, but again, one of the interesting things here is the lack of amplitude in the currencies that we've seen so far, in the credit markets, and here in the dollar, in the sterling. Okay, so now the last item, of course, is the equities. And let's start with the S&P, since it is the widest based US currency pair. Okay, this is the S&P 500. The uptrend has nothing to do with the election. However, it did break in mid-October. It, of course, suffered a fall in June, a very steep, narrow, and quickly forgotten fall in June of this year. But it has started responding to the prospect of various election consequences. Now, this is a move from about 1840 or so, 1835, all the way up to almost 220. Substantial move. Roughly 20%. So this fall here is much less pronounced than that, but it is showing you the direction. This is, I think, something that we all have to be very aware of. These moves are indicative, and these directions are indicative of a priced in status in the markets. The markets have priced in a Clinton victory. Not perhaps as strongly as they had before. You can see the recovery here, back to only this level. You can see and this is the S&P. You can see the recovery in gold. here, from here down to here. You can see the recovery in almost anywhere you would like. This is Euro number year to date. So the email controversy from the Fed has clearly, in the minds of traders, done some, in the minds of markets, done some permanent damage, at least pre-election, in perception to the strength of the Clinton performance. Because we're not getting the kind of levels. Now, granted, there's not a lot between, that's only two figures. But it's telling you that markets are no longer quite as certain as they were of a Clinton victory. And I think that is a fairly logical point of view to take. Okay. Now let's look at the Dow. Okay. Again, I know it's being a little repetitive with these charts, but markets essentially, not essentially, markets have the same perception of the politics of this election and its market impact. As with the S&P, the rising trend in the Dow Jones goes back to the February bottom, and its turn has more to do, at least in the early stages, certainly, with the evolution of the US economy than it does with any particular repercussions from today's election. Certainly pending repercussions. But we can see the same pattern here. Not unexpectedly. You can see this is where charting actually comes in. You can see that this move right here was absolutely related to the 1, 2, 3 prior bottoms in the Dow index, and then a scoot through right there, and it hasn't gone back since then, back to the upward trend. So we have also here Clinton's email reinvestigation and the finding by the FBI that there was no further action to be taken related to Mrs. Clinton's private email server. Yesterday, the Dow went up 370 points, pretty astonishing run. So if you're looking for an emotional high point, that would probably be it. But the point I want to make on all of these charts is that the amplitude, the actual absolute movement in markets in response to this election is, to the prospects of this election, is much, much smaller than the movement and the trend relating to the basic interest rate differentials and economic prospects, if you will. That's what interest rate differentials are presumably based on. So the results today, the key point I want you to remember in your trading through the day, any stop losses you put on your positions, is what we have demonstrated here. The markets have, and there's no great, make sure this is still up, revelation in this. The markets have priced in a Democratic Clinton victory. I don't think they're paying much attention, not the trading markets anyway, to the prospects for the Democrats and the Republicans in the Senate. If Mrs. Clinton does win and the Democrats regain control of the Senate, then I think you will probably see a greater reaction move. If Mrs. Clinton simply wins and the Republicans retain control of the Senate, I think you will see a much smaller move. It won't be much of a move in my opinion, in any case, since the Clinton victory is already priced into the market. If, however, Donald Trump wins, and remember my graph of earlier, this is not the far-fetched possibility, I believe at any rate, that it's being presented in some precincts of the media. If Donald Trump wins, and as this rolls through the reporting tonight, starting around, I believe around 9 o'clock New York time, Eastern Standard Time, then you will see there will be potential for extreme volatility. In this case, I would say more so in the equities than in the treasuries, the credit markets, or in the currencies. If I'm looking for a scale of volatility, I would say the equities probably come first. If Trump wins, the equities probably come first. Gold probably comes second. The currencies third, and the credit markets fourth. The reason the credit markets are last are, as I've said, even if Mr. Trump does win, I don't anticipate any change, at least in immediate Fed policy. Okay, everyone, I hope this was of some use, both here in my explanations of how the U.S. electoral system works, what are the potential, and for your trading positions and the markets this evening. I expect a good deal of volatility. I will be here. It may be interesting. It certainly will be fun. And I hope you join us here at FX, at Worldwide Markets, not FX Solutions, of course, my old company, our old company. And I wish you all good luck in your endeavors today. Everyone take care. Thank you.